Hi, everyone. Welcome to the second installment in our thought leadership series in commodities and international trade. My name is Sumeet Malhotra. I'm a partner at Watson Farley Williams within the firm's disputes group, and I happen to head the firm's commodities and international trade practice globally. During the course of today's webinar, I'll walk you through the definition of STF, how STF is commonly understood, why STF is popular within the commodities and international trade industry, and perhaps also the controversies that surround STF and what the precautions are that one should engage in when considering participation in an STF transaction. Let's start with definitions. STF, or structured trade finance, or commodity backed structured trade finance, is a form of international trade finance that's available to commodity traders. And it's a form of finance that's fully collateralized, that's self-liquidating, that's asset-backed, and so is quite favorable in terms of its structural attributes to lenders. Um, because STF exists within a space that isn't inhabited by traditional lenders, it's very attractive to borrowers as well. And so what follows from that brief description is that STF should be an incredibly popular and widespread form of financing, and one that should compete in terms of volume with traditional trade financing. But unfortunately, that's not the case. STF is considered to be a fairly esoteric form of international trade finance. And during the course of this brief webinar, I'm hoping to walk you through why it's viewed in that manner and why STF hasn't been able to acquire the sorts of volumes that one tends to see in structured trade finance. And we'll perhaps forge for you a pathway into managing the risks that are inherent in these structures so that you'll be able to participate in more such structures. And to the extent that you already do participate in this market, perhaps we'll be able to lead you to an understanding on how best to manage the risks and balance the benefits that are available through this form of financing. Now, why do I describe STF as a fairly esoteric form of international trade finance? And perhaps I could explain that perception that I have and that perception that the industry has by telling a little story. It was the year 2008, and yours truly was a very junior lawyer at an international commodity trader. And I remember that point in time, I was a fairly traditional commodities lawyer. I dealt with the more traditional physical parts of our industry. And I remember seeing my colleagues that served the STF business, which was held within that international commodity trader, as these alchemists and wizards that had the ability to design structures that enabled our principal to print money out of nowhere with limited risk. And we had no understanding at that point in time of how these deals were structured. And so we had a great deal of respect for the arcane arts of trade finance that were practiced by STF practitioners within that organization. Now, 2008, for those of you that are of certain vintage will recall, was a momentous year for the industry. Bear Stearns went down, Lehman Brothers went down shortly thereafter, and the industry changed forever. Towards the end of that year, in the final quarter of that year, most international commodity houses were beset with a series of defaults, and a number of those defaults were on STF transactions as well. Now, as talented as my colleagues who were on the STF side were in the management of structures, none of them were disputes lawyers, which I happened to be at that point in time in my career. And so they turned to me and they asked for assistance with the resolution of disputes that had arisen out of structured trade finance structures. And that, ladies and gentlemen, in 2008 was my first exposure to this area of business. Now, the cause of action, the defense that was used by the obligor in that default that I was called on to assist my colleagues in managing, will give the viewer an insight into one of the biggest risks that's faced by participants in structured trade finance transactions. Without getting into the details of the underlying deal, which I will hopefully be able to get into in a later part of this webinar, the fact was that the obligor in that situation sought to recharacterize the true nature of the underlying transaction. The defense that they adopted was that we aren't obliged to pay the monies back to you that you lent us by way of this commodity structure, because this commodity structure is an act of subterfuge. Although you have characterized this as a traditional trading transaction, this is in fact not a traditional trading transaction. This is structured. Had we known that it was structured, we would have never participated in it. Ergo, we are no longer obligated to perform our end of the bargain, and hence we're no longer bound to you. Now that, ladies and gentlemen, is what we refer to as recharacterization risk. And recharacterization risk is the central risk that I will be talking about today in terms of what it means and what one can do to mitigate recharacterization risk. In order to truly understand the nuances of recharacterization risk, perhaps we should take a step back and understand how commodity structured transactions, STF transactions, are structured, and then perhaps to talk about how recharacterization risk manifests and how it might be managed appropriately. Now, take for example a bog standard STF structure, also known as a corporate funding structure, where a corporate comes to you, a commodity trading principal, and says, I need your assistance with structuring a transaction that allows me the benefit of $100 million of financing for a certain period. Let's call it 360 days. And so you say to this borrower that, yes, of course, we can structure a transaction like that. We can structure it in such a way that it remains off balance sheet. It isn't treated as debt. We make sure that it's fully collateralized and self-liquidating so that we're risk-free. And you'll have the benefit of the monies. And this is the way we do it. So let's take a look at how these transactions are structured. You've got the borrower who needs the benefit of the cash. You've now got the commodity trader that says, okay, borrower, I'm going to sell to you a parcel of goods valued at $100 million. But your payment obligation under this transaction is a deferred payment obligation. So I'll give you 360 days of credit. So you've now got a parcel of goods worth $100 million, but you've not paid anything for it, and you'll only have to pay for it after 360 days. And then I, the commodity trader, will repurchase, either through the same entity or through a subsidiary, the exact same parcel of goods from you. But I will pay you at sight. I will pay you immediately. So now what happens is you, the borrower, have had the benefit of cash in of $100 million. You're allowed to keep that cash for 360 days, and your payment obligation only arises after 360 days, hence the funding. Now, how does the trader collateralize and secure the position, his position, under this transaction? One way to do it would be if the borrower, in this case, has unmonetized LC lines. They have letters of credit available, LC lines available to them from their lenders, which they aren't using because they don't have trade flows to deploy them in respect of. But what they can't do is convert those LC lines into cash. So what you, the commodity trader, do is you sell on deferred terms to the borrower, to the buyer, and the buyer arranges for the issuance of an LC, naming you, the commodity trader, as the beneficiary thereof. Now, because the issuing bank is an onshore bank that you don't have a relationship with, say, for example, the borrower is located in geography like the Philippines or India, Vietnam, Indonesia, and they've got LC lines with a very well-renowned, albeit onshore bank that you can't really take risk on. What are you going to do with that letter of credit? Instead of waiting for the letter of credit to mature after 360 days, you take that letter of credit and you get it discounted at the counters of your relationship bank in Singapore or in Geneva or in Houston or wherever else you're located. And so you receive your monies discounted at the inception of the transaction. On day one, you don't have to wait for day 360 for that cash to come in. Now here, ladies and gentlemen, is where things start to get a little interesting, because here's really where recharacterization risk comes into play. And let's talk about that for a moment. In the fact scenario that I've just described, a common criticism that comes up is the repurchase of the same parcel of goods, the round tripping, that certain commentators within the industry have tried to characterize as anything but bona fide. And that's one of the criticisms that these structures come under. These various criticisms around allegations of non-tripping, round tripping, non-genuine physical trades, and so on, all fall within the umbrella of what we tend to refer as recharacterization risk. Recharacterization risk is the risk that a party that has made payment pursuant to an STF transaction will at maturity seek to recharacterize the transaction as something other than a standard commodity trading transaction, but rather a financing transaction. Allow me to elaborate. I get that this is where it starts to get a bit interesting and confusing. So you've got an obligor that's made payment against an obligation because it's participated in a structured trade finance transaction. Say an innocent discounting bank who wasn't aware about the structured nature of the transaction. They weren't aware of the repossession, the round tripping of the goods. And they, at maturity, when they realize that they're not going to be paid ultimately by the borrower because the borrower has decided to commit default, it's very tempting for a discounting bank that's caught itself in that situation to attempt to recharacterize the transaction and say, no, 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 this wasn't a genuine trading transaction at all. This was, in fact, a funding transaction. And had we known it was a funding transaction, we wouldn't have funded it. We found cases where trade credit underwriters have found themselves involved in transactions that they didn't realize were structured, and who then attempt to recharacterize those transactions and say to courts and tribunals, no, 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 that is a structured transaction. It's not a traditional commodity trading transaction. I'm a commodity trade credit risk underwriter. I only underwrite genuine commodity trading transactions. This was a financing transaction. I am hereby recharacterizing the nature of the transaction as presented to me, and therefore I'd like to be relieved of my obligations. Now, ladies and gentlemen, unfortunately for obligors that are caught in situations like this, the courts have held, and it is trite, that the mere fact of round tripping or the mere fact of a transaction being structured does not allow you to impugn the transaction. But more simply because the transaction structure does not make it anything sinister or inauthentic or non-genuine. And so one must resist the temptation as an underwriter or a lender to seek recourse and to relieve oneself of one's obligations by recharacterizing the transaction, because that's not an avenue that the courts have left open for obligors anymore. Conversely, commodity traders and borrowers that are engaging in these transactions must nevertheless be careful to manage recharacterization risk, because although the position is trite in law, one doesn't want to open oneself up to allegations, because that's just wasteful in terms of legal costs. If there is a factor, however tenuous or invalid in law, that would allow an obligor to reopen a transaction and claw monies back from you, you as a prudent trader would be well advised to ensure that you've managed that risk. And so there are methodologies to manage that risk. Issuing statements of disclosure. So a case in which I was involved many years ago, I think it was 2017, 2018, something like that. We had a French discounting bank attempt to claw back monies that had been paid under a discounting facility because the issuing bank had gone bankrupt by the maturity date. So the discounting bank couldn't claim reimbursement from the issuing bank. They looked at the true nature of the transaction and they said, hang on a second, these are two subsidiaries of the same commodity trader selling goods to each other and repossessing them. This isn't a genuine transaction. Why are the subsidiaries of the same commodity trader selling goods to each other against a letter of credit? That makes no sense whatsoever. This is a structured transaction. It's not a genuine commodity trading transaction. It's in fact a funding transaction. We were misled, and we therefore feel that we should be entitled to claw back the payments that we made under the discounting. Now, in that situation, we respectfully point to the bank and their lawyers to a disclosure statement within the LC discounting agreement, which said that Party A sells to Party B. Both Party A and B are beneficially owned subsidiaries of this commodity trading group. And so there was, we in fact even had the words, and this is a structured transaction. And so the strength of that disclaimer ultimately won the day, and the court said to the issuing bank, we understand that you're upset by these circumstances, but this is a risk that you took and you charged a commission for it. So you monetized that risk. You received the premium that was required to assume that risk, and you went in with your eyes open. You knew that subsidiary A of this commodity trading group was selling to subsidiary B, and you nevertheless, eyes open as a sophisticated counterparty, chose to participate in that transaction. And so, unfortunately, in that case, for the issuing bank, the courts had little sympathy for their position. Now, the reason why the courts had little sympathy for their position was because the trader had been very sophisticated in managing recharacterization risk. The trader made a material disclosure to the bank and ensured that the terms of that disclosure were never ever disturbed during the course of that transaction. And this leads us into the management of claims that arise out of STF. And let me elaborate upon that for a moment. What we've established so far is that merely seeking to recharacterize a structured trade finance transaction as a funding transaction as opposed to a genuine commodity trading transaction is of little utility to a lender or to an underwriter that seeks to avoid its obligations in relation to a structured transaction. Conversely, it's important for a prudent commodity trader to ensure that they manage recharacterization risk, and I illustrated that in my example, where the disclosure statement that we had issued was the statement that won the day eventually and allowed us to ensure that the monies could not be clawed back by the discounting bank. Now, this is really important for commodity traders and lenders within the STF sphere to focus on. Any material disclosures and representations that are made in relation to the true nature of the transaction must not be misleading. A great deal of care must be taken to ensure operational rigor in relation to the accuracy of representations and disclosures. So say now we've dealt with another case where now we're moving away from recharacterization risk more to the realm of material non-disclosure and reps and warranties that are issued in relation to credit instruments. We've dealt with cases where the parties had agreed that the underlying insured obligation would be that of the sale of LME branded goods. And whereas the obligation which was ultimately reneged upon was for non-LME branded goods. And we've seen tribunals go out and hold that the sale of non-LME branded goods was in fact a material departure from the manner in which the transaction was described to the underwriter, and accordingly the underwriter was relieved of its obligations, with the tribunal notably staying entirely silent on the structured nature of the transaction. So you'll see in this case that I'm talking about, the underwriter sought to recharacterize the transaction as a funding transaction, and on that basis, they shouldn't be obligated to make payment under the trade credit insurance policy. The tribunal entirely ignored those submissions. The tribunal instead seized upon the fact that, no, hang on a second, policy says that they're covering the sale of LME branded goods, whereas this particular shipment was not LME branded. And so we don't care whether the transaction was structured or not. The fact is there was a material non-disclosure or there was a departure from the manner in which the transaction was designed and declared to the underwriter. So that's something that one needs to be very careful of. This, I feel that material disclosures and the accuracy of representation and warranties is the other side of the proverbial coin in relation to recharacterization. And so we strongly advise traders to be very, very rigorous in the maintenance of discipline in the management and execution of STF transactions. So we've established so far, let's do a quick recap again, that recharacterizing a transaction as a funding transaction with a view to avoiding one's obligations is of little utility. It's of no use. If representations and warranties are accurate and are complied with, if all material disclosures are made, then again, it's very difficult to question the bona fides of a transaction, even if the transaction is structured. Nevertheless, banks and underwriters that find themselves in a position where they've got to make payments, where they're obliged to make payments in respect of a structured transaction, but they fear that they might not be able to recoup those payments from their own obligors down the line, should definitely examine the bona fides of the underlying trading transactions to establish that they aren't shams. Now, I'm not saying one must be very careful. There's a very marked distinction here. It's not even a fine distinction. It's important that the audience understand this distinction. A transaction's bona fides can't be questioned on the basis of the fact that it is structured. A transaction's bona fides can't really be questioned on the fact that it's a funding transaction and it results in funding. The courts will have little sympathy for those arguments. And that's been tried and well settled. If material disclosures have been made, if there is no material non-disclosure, and if reps and warranties are complied with as well, it's very difficult to impugn the bona fides of a transaction. But crucially and distinctly, the bona fides of a transaction can most definitely be questioned on the basis of whether or not the underlying transaction is a sham transaction. And so any underwriter or bank that's called upon to make payments in respect of an STF transaction that it fears it will not be compensated in turn for should examine the bona fides of the underlying trading transaction by way of request for information and other means that are available to banks and underwriters in order to ascertain that the underlying transaction wasn't a sham. One must ensure that goods were shipped, that goods were sold in accordance with standard market practice and price, that there was a carrier, in fact, carriage occurred, the bills of lading weren't forged, and so on and so forth. And that's assistance that we can certainly render to underwriters and to banks in examining the bona fides of these transactions. There's a number of other ways in which we can provide assistance. At the most basic level, we do a lot of thought leadership work with our clients who view STF as fairly esoteric and impenetrable and difficult to understand. And as I've demonstrated to you in the course of this webinar, STF isn't really that esoteric of an area of financing. It's actually relatively simple to understand, and the risks involved are relatively easy to manage, provided one has sophisticated advice around that. And so we do a lot of socializing of STF structures to the managements of our various clients, be they trade credit underwriters, banks, or trading principals. Another way in which we can assist is in structuring these transactions. Given the experience that we've gotten on the dispute side, we've seen how these transactions can go quite horribly wrong in certain instances. And we assist our clients not only with structuring the underlying transaction itself and assisting with documentation and so on, but also assisting with the preparation of operational manuals to ensure operational rigor during the course of execution of these STF transactions. We've assisted on the dispute side commodity trading principals in ensuring that they are able to defend the bona fides of a transaction, and so to demonstrate that a transaction was bona fide or that a transaction wasn't impugnable simply because it was structured, and alternatively to assist banks and underwriters in investigating the bona fides of structured transactions. Our intimate familiarity with this business allows us to give our clients concise, commercial, and usable advice in a very cost-effective manner. And so if you've got any questions at all about the management of recharacterization risk or the method and manner in which these transactions can be structured, we're at your disposal. Get in touch with a member of our team and we'd be delighted to set up a conversation. Thank you all for your attention. It's been a real pleasure and a privilege to be in front of you today. I look forward to carrying on this conversation with all of you. Thank you again.